Indian benchmark indices like the Nifty 50 or Sensex 30 are really important for us investors. Now, the Nifty 50 in particular is widely used to gauge the overall market sentiment. Now, it gives us a broad view of the performance of the Indian equity market by tracking the movement of the 50 largest and most actively traded stocks across different sectors. Now, any changes in the compositions of these indices are actually quite important. Now, speaking of which, there's an interesting update. LTI Mindtree is going to enter the elite Nifty 50 club as Hdfc shares will cease to trade from July 13 due to the mega merger of Hdfc and HDFC Bank. Now, the adjustment for Nifty will happen on July 12th and will be effective from July 13th. So, LTI Mindtree will be replacing HDFC in the Nifty 50 and Jindal Steel and Power will take LTI Mindtree's place in the Nifty Next 50. Now, not just that, many other stocks will also be replacing HDFC on several indices. Now, when a stock is included in the benchmark index like the Nifty, it attracts investments from passive funds such as index funds and exchange-traded funds that track the index. Now, also, inclusion in a major index like the Nifty increases a company's visibility. According to Nuvama Institutional Equities, LTI Mindtree might experience a net inflow of around $125 to $130 million because of its inclusion in the Nifty index. Now, their estimates suggest that LTI Mindtree will witness passive inflows of approximately $172 million. However, it's worth noting that there will also be some outflows of around $50 million due to adjustment in the Nifty Next 50. So when we consider both inflows and outflows, the net inflow for LTI Mindtree is expected to be in the range of $125 million to $130 million. India has made some incredible strides in global commercial service exports over the last 2-3 decades. According to a recent report by the World Bank and World Trade Organization, India's contribution has actually doubled during this time, reaching a remarkable 4.4% in 2022, up from just a modest 2% share back in 2005. Now, according to the report, among the developing economies, there were 4 countries that stood out in terms of their impressive trade performance in services. Now, they were China, Hong Kong, Singapore, and of course, India. Now, this rise is possible because of our booming service industry, which has been considered the fastest growing sector in India, contributing over 50% to our country's GDP. Now, it's worth noting that even while our merchandise goods exports have not been doing very well on the back of a global slowdown, our service exports have remained strong. Now, to put things into numbers, our goods exports fell 10.3% year over year in May, and our service exports grew 7.5%, defying the global slowdown. Now, vast subsidies and tariff protection are offered to attract manufacturing companies to shift from China to India, but our service exports are soaring without subsidies or tariff protection. Now, though India is climbing up the ladder, we still need to upskill and reskill our workforces. We need to invest in the development of a domestic service sector, especially in terms of research and development. Now, this will ensure that we keep up with the rapidly changing technology, remain competitive, and continue moving up the value chain. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com